margin. We're going to go over what it is, how to use it, and the risks associated with it. Here's everything you need to know. Let's go. Okay, so let's just start with what is margin. And margin is when you borrow money from your broker. And so when you deposit $1,000 into Questrade or Thinkorswim or Interactive Brokers, whatever one it is, depending on what you buy, they will be willing to lend you money based on how much you have in your account and how much you have in that position. And so if you look at a specific stock, for instance, Visa Incorporated, I pulled this from Questrade. I just clicked on stock view. You can type in any ticker symbol you want. And when you see long MR and short MR, this stands for your long margin required and your short margin required. Margin required means how much money you have to have in the position and how much money Questrade is willing to lend you. So in this case, long and short just mean when you buy and when you sell. And for Visa Incorporated, for you to buy the stock, you have to own at least 30% of that position, and Questrade is willing to lend you up to 70% in the other case. So for every $30 that you buy a Visa stock, Questrade is willing to lend you $70. Now, it does depend on the stock that you invest in. So here's a quick screenshot of my portfolio, and as you can see, most of the stocks that I hold are actually 100% margin required, and that means that Questrade is not willing to lend you any money for those particular stocks. The reason is because they're very small cap stocks, they're pretty volatile, and Questrade doesn't actually allow you to borrow money against them. However, Apple, Visa, MasterCard, Microsoft, any of the big name companies that you're probably familiar with, you can probably borrow against those stocks. Now, when you use margin, it is going to cost you money because you're borrowing that money from Questrade, and so they're going to charge you an interest rate. Now, in Canada, it basically works out to the prime rate plus an extra fee depending on if you're in a margin account or if you're in a registered account. So in Canada, it works out to almost 6%, and if you're in the US, it works out to 7%. So depending on which currency you are using and which currency you are borrowing, you will be paying about 6 or 7% per year for that money, and you only pay on that money when it is held overnight. So if you're day trading and you are using margin to day trade and you're entering and exiting in the exact same day, it will not cost you anything to use their money. However, as soon as you hold overnight, you will be charged an overnight holding fee for borrowing Questrade's money. That's super important to know. Okay, so let's look at an example of margin now. So let's take Apple as an example and say the price is $100 and the margin requirement on the stock is 30%. If you buy 5 shares of Apple at $100 and you pay $50 and you borrow $50 for each share, that's going to give you an initial investment of $250 in 5 shares of Apple, and the entire investment is going to be worth $500. Now, let's say that the Apple shares go up to a price of $130 and you sell. That means that you are going to have to pay back Questrade the $50 per share, but you are going to profit $80 per share. That means that on the entire trade, you're going to get a net profit of $400. You're going to get $80 per share, your net profit per share times 5 shares. So a total net profit of $400. And your initial investment was only $250. So you've increased your money by $150 on an initial investment of only $250. So over 50% increase by using the margin instead of a 30% increase if you had bought the shares. So that's the difference, and that's the advantage, is that if you're using margin, you just made over 50% because you made $150 on a $250 investment, whereas if you didn't use the margin, you would have made that 30% difference when the stock went from $100 to $300. It would have cost you an initial investment of $500 and you would have finished at $650. Now, let's say that the Apple shares go the other way and the Apple shares actually fall to $60. So this is where it starts to get complicated. Now, your position in Apple, the $500 shares, is now only worth $300. And Questrade has given you $250. So realistically, there's only $50 left in that position of your money. And when you do the math on that position, you have $50 in and Questrade has $250 in, you no longer meet that 30% margin requirement. And unfortunately, what happens in that case is you get a margin call. So this is a margin call that I actually received from Questrade, and the first thing that I want to do here is just point out to you the time that I received this at. Questrade was wonderful enough to wake me up in the morning at 6:54 a.m. with a wonderful, bright, smiling margin call that said I owed them a whopping $86. And now they do give you a couple of options on how to pay this, but basically this is the nice version of the margin call when you get an email that says please pay your X amount. That's the nice version. The mean version is when you get somebody that actually calls you and says, hey, you have a couple of options here before I liquidate your account. That's the mean version. And then the worst case scenario is somebody just chooses which stocks to sell. So the idea here is that you no longer meet the margin requirement. You're borrowing too much money from Questrade, and therefore they have to sell some of your positions in order to bring you back into those requirements. So that's the idea here. So definitely not a fun way to start your morning, and you need to make sure that if you receive one of these emails, you handle it right away and you handle it the right way, because it's really, really important, and it's not a nice way to wake up in the morning. It's absolutely just a gut-wrenching feeling until you realize it's only $86. Then it's not a big deal. It's like, well, don't even email me for that, but that's okay. So margin call, there's a couple different options that you have once you receive one of these. Basically, you receive it because you no longer meet the margin requirements. And so the options that you have are there to get you back into meeting those margin requirements. Unfortunately, they're not going to change just because you had a bad trading day. You have to change and get back into meeting those requirements. And so you have 4 different options to do that. Number 1 is deposit money into the account. And with Questrade, they actually write in the email that you have to send them a screenshot of that transfer as proof of payment. So really, really interesting there. They want their money right away, and e-transfer or a money transfer might take a couple days, so they want to know that you've sent it. So really, really interesting. The second option that you have is to close enough positions to satisfy the margin requirement. So if you have a variety of open positions, it's going to look at your account as a total. However, if you only have one position and that is the margin trade, it will look at liquidating that position or anything else that you might hold. That's the big thing there. The third thing is if you have any open orders that basically take your money and say, yeah, I want to buy this at a certain price, and that can affect your buying ability and your margin. So Questrade may just cancel those orders without having to liquidate any of your shares. That would be a good option for you, but it will get you out of those positions. And if that stock decides to run, you may miss out on a big run. Now, the fourth option is to connect your other accounts to give you more margin. Now, I've seen this done a couple of times where somebody has a margin account that they day trade in, and they also have a tax-free savings account. You can actually tie your cash in your tax-free savings account to your margin account to give you more margin in your margin account. And so I know that sounds complicated, and unfortunately you're actually risking some of the assets you have in your TFSA. You're basically guaranteeing them, but it can give you more margin as long as you use it responsibly. It can be a good thing. Or if you already get that margin call but you got 50 G sitting in the TFSA, you can link that basically position to your TFSA so that you don't have to liquidate anything. I don't recommend that because then you're tying up your long-term positions and basically holding them as collateral. If that position is already getting a margin call, you may want to reevaluate just getting out of that position and liquidating right away, because if it's already at that point, it might be a bad sign to begin with. Now, things you need to know is that if you do nothing, they will just sell your positions for you. You cannot ignore a margin call, and if they have to sell your positions for you, there's usually a surcharge. Depending on what broker you use, they will charge you a fee to basically come in and forcibly sell your shares. With Questrade, I think it's about $45, and if you don't have enough money into your account, I believe that you can also be sued and held liable for those losses. Now, a couple of things that you need to know about margin accounts on Questrade. Number 1 is they can be used as cash accounts if you do not borrow the money and you do not use the margin on that account. A margin account and a cash account are almost the same thing on Questrade, just don't use the margin. Pretty simple. The second thing is that you must convert your currencies before you trade. Otherwise, you'll be using margin and paying interest. So what I mean by that is if you put $1,000 Canadian in there and then you go to buy a couple shares of Apple stock in the United States, if you do not convert your Canadian funds to US funds before you make that trade, you will actually be buying those Apple shares on margin and borrowing that money from Questrade. The only downside there is that you're going to be paying interest on it, especially if you hold them long term. So if you're basically buying in and you're going to hold Apple, or you're going to hold whatever stock in the other currency for 6 months to a year, just know that you're going to pay 6 or 7% in interest on that directly to Questrade. Now, if you need help changing that money over, all you do is sign into your account online. You go to the web broker in Questrade, sign in, click on requests here, and then exchange funds, and then you choose your account, and you can basically choose whatever currency you want to convert it into. It's really, really simple. If you don't want to be borrowing money and paying that interest, I highly recommend you do this. Now, in summary, what I'm trying to say here is that a margin call is the absolute worst way to start your day, and so you want to do everything you can to avoid that. Make sure that you're managing your risk appropriately, starting with a diversified portfolio, good position sizing, good stocks that you're actually holding and that you actually like, and that you have managed the risk appropriately with a stop loss or at least an exit point where you know if the stock gets there, you are wrong and you're just going to get out of it. Drop the losers fast, add to the winners, take your profit when you need to, and we will see you guys in the next lesson.